When President Barack Obama came to office, he inherited a big financial crisis, and much of it centered on the banks. Early in his tenure, Mr. Obama appointed Daniel Tarullo to the Federal Reserve Board, and Dan became the point person for constructing an entire new set of regulatory structures designed to make sure we didn't repeat what happened in 2008. Late last week, Governor Tarullo announced that he'd be stepping down in just over a month, and he's here now to review where we are and where we need to go. Welcome, Governor Tarullo. Great to have you here.
Thanks. Good to be back with you, David.
And welcome also to our radio listeners. This is so important, Dan, that we're putting on radio as well as television all at the same time. So let's start with the big question. You came in, a lot of things were broken. I think almost everyone would agree with that. What remains broken after 8 years in terms of the regulatory structure?
Well, I don't know that there's anything so severely broken that we should be worried about any immediate consequences. But I do think that the two areas in which we've tried to concentrate over the last 8 years still need attention. And the first of those is, of course, the very largest firms that have been characterized as too big to fail. There's been a lot of progress there, but there's more work needed. And secondly, the nature of the crisis in 2007 and 8 reminded us that the nature of funding in a financial system in which traditional lending and capital markets are so integrated is just as runnable as in the 1920s when bank deposits were not insured. It's a different form of funding now. It's repo, it's securities financing transactions. But the runnability of that funding combined with the big drop in a key asset price, housing, was what produced the crisis. And we need to be constantly on the lookout for vulnerabilities with runnable funding. And I think that's, by the way, an ongoing exercise. You're not going to come to a point where you say, OK, that's done, now we move on.
So let's start with the first one you mentioned,
Right.
which is too big to fail. We have Gary Cohn just a week ago or so, when they had the executive order, came out and said, we have not really addressed the too big to fail. We have Congressman Hensarling, actually, we'll play a little thing of what he had to say, saying we got a big problem with bailouts. Let's play that.
What's most important to the American people, and that is to get out of the bailout business. And unfortunately, Dodd-Frank didn't end bailouts, it enshrined them into law. That has to change.
So are they right? And if so, what needs to be done in order to fix the too big to fail problem?
Well, I think they may be saying somewhat different things. I do think there's been an awful lot of progress made in addressing the too big to fail problem. The resiliency of our largest, most systemically important institutions is substantially greater than a decade ago. Capital levels are way up. Because of that runnability that I mentioned a moment ago, we now have both liquidity regulations in place and much better liquidity management systems by the largest institutions. We have made progress on a resolution regime that will make sure that no individual firm is too big to fail. It can be resolved in insolvency. I don't think we're there yet, and so that's one area where more progress is needed. One thing I will say, David, I think when someone comes and tells you we've solved the too big to fail problem, that's when you should begin to get worried.
It's almost insoluble by definition.
I think because the financial system adapts so readily and so expertly in a lot of ways to create new opportunities for making money, the financial regulatory system needs to be attentive to those changes and to evolve with it. And by the way, that's what didn't happen in the pre-crisis period.
I do wonder, though, Governor Tarullo, if we're getting into a cycle where people are forgetting the financial crisis and exactly what you just mentioned.
Yeah, so that's an excellent point. And you know, if we just go back to a decade or 12 years ago, what was the state of the financial system, including some of our biggest firms then? One, even though capital markets and traditional lending had been integrated, when firms priced for risk, a lot of the instruments in which they traded, they didn't take into account the credit risk that was embedded in those instruments. Mortgage-backed securities are the best example. Two, they were not attuned to the possibility that across the system you could have a liquidity squeeze as everybody pulled back saying we're not sure about asset prices, so for the moment we're just going to stay on the sidelines. Three, in many instances they did not even know what their own risk was. In 2009, when we ran that first set of stress tests on the fly, as it were, we sent out requests for information, and more firms than one would have expected were not able in anything like a reasonable period of time to aggregate risks to the same counterparties from across their big firm. those are the things that produce the regulatory changes that we've put in place, and those are the things which shouldn't be forgotten as a historical matter, but as I said a moment ago, the kind of adaptations in the financial system may mean that new risks are created along the way.
How central to the regulatory structure at this point are those stress tests?
I think that they are the single most important supervisory innovation, not just since the crisis, but really for the last 20, 25 years. What do the stress tests do? Stress tests first try to look at a sizable portion of the U.S. financial system at the same time to see how a recession or a particular move in asset prices would affect all of the larger and just a little bit less than largest firms. Second, they're dynamic. We change the scenarios from year to year precisely so that we test for different things, because you don't know where the real stresses in the system are going to come from. And third, it is a way of allowing us not only to make sure that firms have enough capital and that they don't, as in 2007, continue putting out dividends when their capital is shrinking, but also it's an opportunity to make sure that their own risk management systems, quantitative and qualitative, are attuned to the idiosyncratic risks that their own firms may face. And there's just one other thing to add. Yes, the largest, most systemically important firms need the stress test, but there's a reason why we go further down, and that is you need the whole system able to intermediate credit even in a severe recession. So with very large regional banks, which individually are probably not too big to fail, we still want to make sure that as a group, those banks are resilient enough to continue providing credit to U.S. households and businesses.
Governor Tarullo, I want to go back to what you said, more work needs to be done in terms of too big to fail, and you laid out some things. Are there banks, though, in our financial community right now that are too big to fail and should be, to some extent, broken up a little bit?
Well, what we've been trying to do is to set the regulations at the point which we think is appropriate in order to take account of the additional risk to the financial system that any such firm creates, and then to have the firms themselves decide the most efficient way to deal with those regulations, whether to hold a lot more capital liquidity or, as we've seen, to get out of some businesses, to reduce exposures in other businesses. In a way, we're trying to use a kind of pricing mechanism which gets them to decide the best way to do it. I do think that we've got to continue to do that. That's why I mentioned last fall that I thought we should integrate the surcharge for the largest banks into the stress testing regime. And it's also why we need to continue to work on the resolution regime, because that, importantly, doesn't just say, gee, give us this big plan that we'll pull off the shelf in the event that you're failing. It forces the firms to change the way they operate day to day, precisely so that if you get to that Friday afternoon, you're not facing a situation in which there's no liquidity to deal with the stress.
Now, for those of you just joining us on television and radio, we are speaking with Federal Reserve Governor Daniel Tarullo. And Dan, I asked you about what yet needs to be done. Are there any places you went too far in retrospect that you would dial back? And particularly, let me ask you, is it possible to require that the banks have too much capital?
Well, in a theoretical sense, sure, you can require they have too much capital. But I think when we're talking about these very largest institutions, and you see the stress on the system that any one of them could provide if it were failing, then you understand why, in order to provide a buffer against that, the banks, those kinds of banks, will need to hold more capital than they might individually decide they want to. Now, when you get to banks that are medium-sized, smaller, and certainly community banks, I think that they have a point that the post-crisis regime, both supervisory and regulatory, that's been put in place, in many instances cast the net perhaps too broadly or deeply. I've been particularly concerned with the impact on community banks. The risk-based capital rules had to be changed to take into account what the big regionals and the largest banks were doing. But in the process, those same rules apply to community banks. And I think in this post-crisis period, we need to think more in terms of pretty sizable or pretty distinct changes and differences in the regimes applicable to, for example, community banks, as opposed to Citi or Goldman or State Street.
So have you seen in your data that you look at actual tangible harm done to the community banks because of this? For example, in lending, is there less lending going on than should be going on?
Well, it's very... my sense has been, poring over the data, speaking with bankers, and my sense has been that the biggest problem remains demand for lending, by small businesses and by, in some cases, consumers as well. If you look at the NFIB index, National Federation of Independent Business, you'll see that a very small percentage of smaller firms say they're having a problem getting a loan when they think they need one for expansion. The problem is the demand. But for any small bank, any regulation or supervisory exam creates a cost that it cannot amortize over hundreds of billions of dollars of assets. It's amortizing it over a few $1 billion of assets. They have 1 or 2 or 3 or 4 compliance officers. So when you're pushing up those costs in a way that is probably not necessary, you are having an impact on the profitability of those banks. And let's face it, small banks are subject to enough pressures for economies of scale and the like. I don't think we want the regulatory and supervisory system to be an additional challenge for them, given the market challenges they face.
So, Governor Tarullo, I think 70 to 80% of Dodd-Frank have been implemented. So we've seen financial firms, banks do a lot of work already. What do you anticipate will happen in terms of financial regulation? Will we see a rollback? Will banks kind of roll back all the efforts, the compliance efforts that they've already taken? And what are the risks, risks here?
I think it's far too early to tell what the outcome of all these conversations, discussions, and proposals will be. I can say that my hope and expectation are that the core reforms that we've put in place for the largest institutions, the increased capital, the stress testing, liquidity requirements, risk management, and the progress on the resolution regime will have durability. And I think they should have durability because I think there's a broader consensus in the country that we cannot repeat what happened in 2007 and 2008, that we do not want more taxpayer bailouts, and that we don't want to repeat the secular harm to the economy that was caused by the financial crisis. And that I think, to get back to one of your earlier questions, that's where memory is important, is to keep that in mind. I have always regarded higher capital and the fight against moral hazard as a place where conservative and liberal economic principles come together. When I was still an academic and I was testifying before the Senate Banking Committee on what was then a set of Basel II capital proposals, I was followed by a quite conservative economist who agreed with what I had just said. And we found that we shared this view that moral hazard is a problem for an efficient capital and market allocation system.
So Dan, quickly, why are you leaving now?
Well, I came in hoping to be part of a group that put these kinds of reforms in place. I had the unusual opportunity, just having literally written a book, to be in a government position where I could put some of those ideas into practice with my colleagues. 8 years is a longish period to have done this, and I think it's probably good for the individual and good for the institution to move along.